This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Good evening, everyone, and welcome to this special edition of Nightly Business Report. I'm Tyler Matheson.
And I'm Sue Herrera. Welcome. We are about a month and a half into the new year, and what a year it has been. Volatility has returned to the stock market like few expected.
And tonight, we will take a look at what that means for you and your money and offer, hopefully, some investing ideas for a market that seems to have a mind of its own.
That's right, and that is where we begin with the stock market. Never before have we seen the Dow Jones Industrial Average fall nearly 1,600 points in a single session, at least until this year. The stomach-turning moves lower and the dramatic moves higher are happening at warp speed. And as Dominic Chu reports, the volatility we've seen will go down in the history books.
After months and years of market calm, volatility is back, and it came back with a vengeance over the past few weeks. It's been so long since investors have had to deal with a falling stock market that many may have forgotten what it looks or feels like. The middle of 2015 through the beginning of 2016 saw the S&P 500 pull back by around 16% as concerns about the Chinese economy and global growth took a bite out of markets. Even during all the commotion surrounding the United Kingdom's 2016 decision to leave the European Union didn't have as big an effect. That so-called Brexit vote only ended up shaving around 6% from the S&P. Another interesting way to look at the lack of volatility up until this point is how long we've hovered near a record high level for stocks. According to LPL financial market strategist Ryan Dietrich, the S&P 500 traded within 5% of record high levels for over 400 trading days in a row. That's the longest streak on record. Many experts think that the recent volatility isn't over. After such a long stretch of inactivity, it may take more than just a week or two to get back on track. In the meantime, financial advisors are busy counseling clients and answering questions about how to react to the up and down market. What it has done is given investors a reason to reevaluate their risk tolerance and portfolio construction, reinforcing the idea that the level of stock market exposure one has should depend on how imminently they plan on using the money. The longer-term horizon you have, the less worried you should be about the market gyrations we have like these. But if you're retired, getting close to it, or need the money for college or a down payment on a house sometime soon, it may not be as appropriate to have a lot of money in stocks. Whatever your circumstances, if the recent market melees has you worried, it may be worth talking to a financial advisor to see if you're positioned correctly in the market. For Nightly Business Report, I'm Dominic Chu.
And joining us now to talk about what we have been seeing in the markets and what could lie ahead is Michael Purvis. He's Chief Global Strategist at Whedon. Mr. Purvis, welcome. Good to have you with us. One of the things I think we probably can all agree on is that this market is not 2017's market anymore, and that there are two things that investors haven't had to think about in years that they're now finding themselves having to think about: rising inflation, or the prospect of it, and rising interest rates.
That's absolutely right. We're starting to see bond yields do something we haven't seen in a long period of time. As Dominic was just mentioning, when you had volatility, the VIX going up, for example, you would typically see bond yields going down. And what's happened over the last couple of weeks is that bond yields are not going down. And I think that's really starting to raise some unsettling questions for investors.
What about the volatility? It was so violent on those couple of trading days. Do you have a feeling that that is over? Was it linked to any particular instrument? What's your take on that?
Well, there's been a huge industry that's developed over the last few years of effectively selling volatility, and that's a investment or trade that works great until it doesn't. And what happened over the last 2 weeks was really it's what you'd call on Wall Street a short squeeze, and just happened to be these volatility instruments, and so it created a lot of sort of market violence that we don't normally see. And there will be aftershocks from that. But I think the question for investors who do have, say, a 12 or 24-month time horizon is really anything that different than it was back in early January, besides these reverberations from this volatility squeeze.
With that as a backdrop, do you think the stock market is going to churn higher, albeit potentially with more volatility?
I think that's exactly right. The fundamentals are really good. It's kind of interesting to note that over the last 2 weeks, the outlook for expected earnings for the S&P 500 actually increased almost 2%. That's not my numbers, that's consensus. And the fundamentals are really strong here. So what I'm expecting is we're going to have a few weeks of choppy trading. Ultimately, I think what you're going to start seeing is the U.S. equity market continue to rally forwards. But going forwards, as interest rates go higher, that will mean that there'll be more volatility going forward. So I think both volatility and the market will range higher later through this year.
So if you had to commit, if you have a longer term time horizon and you want to commit some cash to this market, where do you see opportunity?
Well, I'd say right now, the best thing to do is just sit back and wait for some of these aftershocks to play out a little bit. You don't need to rush in tomorrow there. But I think, good, solid companies that have been working over the last couple of years, the tech sector, for example, I think will continue to do quite well, regardless of where interest rates happen to be going. I also think the financial sector is another good area where it will benefit from a higher interest rate environment, and the volatility that we've just been discussing will help their trading businesses as well, which have been pretty lackluster over the last couple of years.
Michael, thank you so much. Michael Purvis is with Weeden and Company.
Well, some say the stock market is taking its cues from the bond market. Treasury yields are starting to rise, and that's causing stocks to adjust. But where do interest rates head from here? Steve Leisman takes a look.
One of the reasons for heightened volatility in stocks is more uncertainty about the outlook for interest rates. There's a lot for equity investors to figure out about just where interest rates and the Federal Reserve will go from here. On the supply side, the Fed is reducing the balance sheet, ramping up to $600 billion a year and increasing the supply of treasuries on the market. Government borrowing is set to rise back up to $1 trillion a year to finance the deficits, among other things, from the tax cuts. And the right rate will rise to reflect better growth numbers in the economy. At some point, a higher treasury yield will begin to compete with the return for stocks. The long rate in turn feeds back on the Fed. They hope to set a short-term rate at the rate to continue economic growth, but if growth is better, they could view that rate, the short rate that is, being higher than it is now. So far, New York Fed President Bill Dudley says the market turmoil hasn't hurt the economy or changed the rate outlook, at least not yet.
Having a bump like this has virtually no consequence in my view of the economic outlook. My outlook hasn't changed just because the stock market's a little bit lower than it was a few days ago. I mean, it's still up sharply from where it was a year ago. That said, if the stock market were to go down precipitously and stay down, then that would actually feed into the economic outlook, and then that would affect my view in terms of what's the implications for monetary policy.
Dallas Fed President Robert Kaplan added that market corrections can be healthy. We'll hear more from the Federal Reserve on February 28th when new Fed Chairman Jerome Powell sits for testimony before Congress. It's the first time he'll take questions at the helm of the Fed. For Nightly Business Report, I'm Steve Leisman.
Well, when the Fed does raise interest rates on deposit accounts also tend to rise, albeit slowly. The Fed's latest rate hike has yet to result in more money in savers' pockets. So with the Fed expected to raise rates 3, maybe even 4 times this year, when will being a saver pay off? Here to discuss that is Kimberly Palmer, banking and personal finance expert at the personal finance website NerdWallet. Welcome. Good to have you with us, Kimberly.
Thanks for having me.
You know, when rates go up, I notice very quickly that the rates on my credit cards go up. My rates on my home equity line go up. The prime rate goes up. That's all the rates that banks charge to borrowers. But the rates on my savings account don't go up nearly as fast. I guess this is how banks make money, isn't it, Kimberly?
That's right. The traditional banks have been slow to raise their interest rates that they're paying savers on their deposit accounts. But at the same time, we have seen more movement with online banks who are offering more competitive rates. So we've seen those rates on savings account go up to 1, even 1.5%. But you're right, the traditional banks have been slow to increase those rates.
But if they did increase those rates, wouldn't it behoove them to do so because you would keep your money in that bank longer?
That's right. From a consumer's perspective, it's very appealing when a bank raises the rates, and it encourages people to put more money in their savings account because consumers, of course, want to make sure they are earning as much as they can on their savings.
You just mentioned something very interesting, and I want to probe it a little bit. You said, I believe, that the online banks pay higher savings rates. If I want to buy a CD or put $10,000 in a savings account, is that where I should look first? And how do I do it?
Absolutely. There are, of course, a lot of factors at play, but one of the smartest moves for consumers to make right now is to spend some time looking online, comparing the different rates that banks offer, because you will often find that the online banks are offering more competitive rates.
Where can I do that comparison, Kimberly?
Well, you can do it at NerdWallet, of course.
I had to give you that. That's called a Roger Federer could have smashed that. Go ahead. NerdWallet is a good place to do that.
That's right, it is. You can easily compare rates. And I mean, for consumers, it's so important to make sure you're earning as much as you can for your savings. So that's really the bottom line for consumers.
You know, I've talked to some people who say, I'm uncomfortable with an online bank. What do you look for when you're looking at an online bank to potentially put $10,000, $20,000, $30,000 into?
That's such a good question, because security is absolutely the #1 concern. You always want to check, first of all, that it's FDIC insured. And then you also want to make sure you understand how to access your money. Are they on an ATM network? Can you easily take out money when you want to? Will you be able to keep fees to a minimum? Those are all important questions to ask.
So are more and more people using these online banks, or are they still inclined to just go with the familiar name that's either the corner local bank or one of the big multi-state banks?
We actually are seeing a lot of growth and interest in online banks, and there's a growing comfort level with online banks. So that's a trend that we're seeing over time as people seek to get higher returns on their money.
All right, Kimberly, thank you so much.
Thank you.
Kimberly Palmer with NerdWallet. Still ahead, trying to figure out what you should do with your money in a volatile, rising interest rate environment. We have 2 guests and a lot of ideas. Topics that we've been discussing a lot lately have been higher interest rates, which we just did, and rising volatility. With that in mind, let's talk about what stocks could benefit from those 2 themes. Here with us to discuss 3 picks that could do well in a more volatile market is Chris Bertelsen, president of Aviance Capital Management, and we're also joined by Bill Smead, who will focus on 3 stocks that are expected to benefit from rising rates. He is the CEO of Smead Capital Management. Nice to have you with us, gentlemen.
Great to be here.
Bill, I'm going to start with you, if I could, because we just talked about the fact that banks aren't necessarily passing along those higher interest rates, but you found a couple of stocks that you think will benefit. Let's start with your first one, Amgen. Why do you think it will be the beneficiary?
When the economy gets stronger and interest rates rise, ultimately you'll also get a contraction in price-earnings ratios. Companies that produce their own capital become much more valuable than companies that demand capital. So if you have loads of cash on your balance sheet, generate high free cash flow, and have a lot of demand for your product regardless of what the economy does, life should be pretty good, and that pretty much describes Amgen. And then lastly, it also trades at a very, very low price-earnings ratio in relation to the rest of the market, which also is a very positive in a more defensive environment.
All right, so Chris, in this scene, your motivation is to pick stocks that might benefit from increased volatility. But your 3 choices are very interesting in light of what's been going on in Washington. They are Lockheed, Raytheon, and Northrop. That feels like a play to me on higher defense spending in the U.S. and around the world. Why are they also good in a volatile market?
Absolutely. The old sports analogy that the best offense is a defense really applies here. And you can certainly play defense pun intended, by owning these companies. Just take a look at the volatility burst that we've had. These companies were down maybe 2 or 3% at most when the market was falling off 10, 11% from its high. And year to date, they're up 8 to 11%, and they're really participating as the economy grows. Never underestimate the power of the government to either make a business run or to maybe hold it back a little bit. And with a $700 billion budget passed for defense spending and the rest, they will actually really benefit each quarter of earnings for, I think, the next 8 to 10 quarters. So I think you have it really a situation where you can kind of own these companies, understand that when you have a tough time, that they won't hurt you.
You know, Bill, let me go back to you on Bank of America, which is your second pick. Obviously, they would benefit from the rising rate environment in terms of loans and things like that. But why else do you like it?
Well, first of all, there's 86 million people between about 23 and 41, and they are forming households now at very large numbers. For example, 65% of the views on Zillow are millennials. So as their economic activity picks up, the amount of little transaction charges that they're doing at the bank goes up significantly. And then you've already stated in your prior segment that over the course of the last 8 to 10 years, Bank of America found out everybody that will have money on deposit with them that doesn't care about what their return is. Any money that's still sitting in savings and checking accounts now is obviously not rate-sensitive people. And you know, your prior guest has a wonderful idea for those that are motivated to shop, but most people are lethargic and also have a tendency to want all their money at just one or two places, especially the older you get. If someone passes away and they've got money in 20 different financial institutions, you've got a real headache on your hands as an heir.
Yeah, absolutely. That is certainly the truth. Chris, one of the other things that I noticed about the stocks you mentioned, again, Lockheed, Raytheon, and Northrop, these are dividend payers.
Absolutely, and they have consistently raised their dividends fairly aggressively. Now, they're not really high yielders, but it'll be like owning the 5-year U.S. Treasury. You're getting at least that type of yield, a little more in Lockheed. And I think that continues as they pass cash and cash flow back to the investor.
And Bill, you get to tell me about Walgreens Boots Alliance. Now, we know that that particular area of the market has seen a lot of consolidation, there are deals going on. I would assume it's a little bit of a play on that as well.
Well, let me jump on the nice pile that our other guest provided. Bank of America will probably see some of the most amazing dividend growth it's just about ever had, because they have been restricted by the CCAR, Federal Reserve requirements on how much they could pay in dividend. And historically, they've paid about 50% of their profits out in dividends. Their estimates, I think average estimate this year is $2.10 for this year, which means in normal eras they'd be paying $1.05, and that's more than double what they're paying now. So they should have big dividend increases. Walgreens has been, they are a dividend aristocrat. They've raised their dividend every year since the beginning of time, practically, and they're gushing free cash flow. And if, in fact, they're able to buy the other 70% of AmerisourceBergen, that's just going to add another bunch of copious free cash flow, and their dividend increases will be substantial. And again, you'll notice Bank of America is more a play on a stronger economy, and then Walgreens and Amgen are both companies that I don't think it really makes a whole lot of difference what the economy does, that we're going to be excited to own them regardless.
Gentlemen, thank you so much. Chris Bertelsen with Aviance Capital Management, Bill Smead with Smead Capital Management.
And coming up, why spring has sprung early for real estate.
That old groundhog recently predicted there would be 6 more weeks of winter, but the housing market doesn't agree. Rising interest rates and falling supply have buyers out early, hoping to get a jump on what could be one of the most competitive housing markets in history. Diana Olick has more.
This $500,000 Denver home was listed on a Thursday.
Yeah, I like this one a lot. And this is $587.
$587 just came out on the 1st.
And it already had 37 showings before the Saturday open house.
There's just simply not enough homes to go around for people looking to buy them.
The home was under contract by Monday. The supply of homes for sale right now is at a record low, not just in Denver, but nationwide. Demand is surging, and that has shoppers out early, hoping to get a jump on the spring market.
It's kind of the off season right now, but I'm definitely still experiencing a decent amount of competition. I thought I was kind of at a higher price point where it would be a little bit easier for me to get a place without a lot of competition, but I've put down 2 offers so far, and both times been beaten out by cash offers.
It's stories like that that have Eric Daniels and Alexa Karras out looking early as well.
We haven't put in any offers or anything, but we understand it's a really tough market.
So we're sort of doing everything we can to be prepared to make a good offer in a competitive market without contingencies and that sort of thing.
Not only are potential buyers facing low supply, but also high prices and rising mortgage rates. A not so perfect storm that has the usually busy spring market starting in winter.
In the short term, I strongly believe that's going to cause a lot more buy-side demand. As people try to get into a home before interest rates get to a point where they can no longer afford a home that they would like.
Higher rates could throw some cold water on overheating home prices.
And they have a whole basement for the kids.
That's true.
But demand is so strong right now that even higher rates are unlikely to cool the competition.
The upstairs is very weird.
For Nightly Business Report, I'm Diana Olick in Washington.
So what trends might we see during this spring selling season? Here to discuss her outlook is Skylar Olson, senior economist at Zillow. Skylar, I'm Tyler. Welcome. Good to see you. Skylar and Tyler.
Thank you.
All right.
Excellent.
So everybody keeps talking about how low inventory is. There just aren't that many houses for sale in many markets. Why is that? Why aren't people putting their houses up for sale?
You know, actually, over time, the number of newly listed homes that are going out of the market is relatively stable, right? It's increasing right now, for example, the newly listed homes, and it'll continue increasing till it peaks around May for the home shopping season. This is when the listings start to pick up. The rub is that demand is so hot that those homes are coming off the market almost as soon as they get on it, right? So homes that are listed at the beginning of the month are not necessarily available at the end of the month. So if we look at daily inventory, how many homes are available on any given day, that's actually 10% lower than it was last year. And last year we would have been having a pretty similar conversation.
What impact do you think higher mortgage rates is going to have on that demand?
You know, I think you could think that the effects might be the effects might be there, right? But they're likely to be small. And one of the reasons why that is well, something we may expect, right? If I expect rates to go up in the future, then I'm going to move quickly now. The thing is that demand is already so strong relative to the supply out there that we might not notice, right? In terms of really seeing a significant cooling. There are a lot of pent-up home buyers that have expected to buy homes, that have been looking to buy homes, that have been bidding on homes and losing out on those bids. And frankly, there are a lot of other barriers to moving into the market, to becoming a homeowner, such as saving for that down payment, than the mortgage rate, which historically, even at as high as it's been since 2014, is historically still very low.
You call this a seller's market and likely to be so as far as the eye can see. If I'm a buyer, a bidder in one of these sellers' markets, what are the 3 pieces of advice you would give me to give me the best chance to get the home I want?
Yeah, I think first off, really consider the reality that you're going to lose your first bid. Across the nation, this is a national average that the typical home buyer has to submit at least 2 bids to win that home. In a hot market, like a lot of the coastal cities, like Seattle, for example, expect to lose 4 or 5 before you win that option. When that happens, you cannot stop aggressively saving for a down payment because if you lose that bid, home values are not going to stop. They're going to move around you, right? And it takes aggressive saving, continual saving, just to keep up with that down payment share, like say 20%, or if you're not there, 10% that you otherwise would have expected. Next, really identify what your min spec is, right? What are the minimum requirements that you have in where you're looking, because you'll have to get flexible.
On that note, thank you so much, Skylar Olson with Zillow.
Thank you so much, too.
Before we go, Sharon Epperson leaves us with some reminders on what to do and what not to do during periods of extreme market volatility.
Well, Tyler, it has been a roller coaster ride that many never expected. The recent swings in the stock market have been especially tough for long-term investors who often buy and hold, but now they may have gotten a little spooked. So here are some tips on how to ride out this wild market. First of all, you know it. Don't panic. Just remember your goals. There's a reason that you started investing. You set a goal. It could have been to save for college or fund your retirement. Whatever your plan, take a few deep breaths. I'm into yoga now. And stick to your plan. The money is there for the long haul, and then it's probably better to be in the market where over time it's going to grow. The next thing is, don't hit the sell button until you've reassessed your risk. If you're losing sleep at night over the market turmoil, your investment mix may be too aggressive. After last year's gains, your portfolio may need some tweaking. Rebalance, diversify your holdings, and if you need cash for a large purchase in 2 or 3 years, rethink that stock exposure. And finally, don't go it alone. Talk to an advisor. Speaking with a pro who's weathered these kind of market moves before may give you a much-needed gut check. And it's their job, especially in times like these, to calm you down. And if you need it, to help you rework your investment strategy. Guys?
Sharon Epperson, thank you. And thank you for watching this special edition of Nightly Business Report. I'm Sue Herrera.
I'm Tyler Mathisen. Have a great evening, everybody, and we will see you tomorrow.